solvency professional, and he has got practical insights because he has been handling valuation matters. And it is not only just passing the exam. If you are aspiring to be a registered valuer, then you should know the subject. And we always endeavor to invite those who are in the thick of things. So with this, over to Nitish Chokji.
Thank you, sir. Thank you for giving me this opportunity. A very good morning to all the participants. Before we start, I'll once again repeat what we have done in the last session. A quick recap over a period of 2 minutes. Let me share my screen. I hope my screen is visible to you all.
Yes, it is visible.
Yeah, thank you. So what we have done yesterday is the definition of business valuation. It is an art or process of determining the value of business ownership interest, security, or intangible assets. So the what is value? We have seen that it's an economic concept and an estimate of likely price. Price is quite different from value. Price is an ex post measure, a precise measure, whereas valuation or value is an estimate and not a static figure. We have busted some myths relating to valuation as well, and we have encountered various situations in which valuations are required. We have gone through in detail the LBOs, MBOs, sell-offs, spins, IPOs, how we can create value in these situations. Then again, we have gone through the premise of valuations and the basis for valuation approaches. That is the perception that the markets are inefficient. And then we have gone through the relative valuation techniques, EV oblique sales ratio, EV oblique EBITDA ratio, PE ratio, price book ratio, price earning ratio, DCF method, FCFF and FCFE. We have gone through relative valuation in detail as well as this DCF method in detail. There are some portion left in DCF method that is relating to the advantages and disadvantages of this valuation. We have covered various examples as well yesterday. I hope the same are clear to everyone. If anyone has any doubt, you can raise the issue in chat box or you can directly raise your hand. So these are the steps. I'll come on this later. First, we'll go through the advantages of the DCF valuation. Since we have, gone through the basis of DCF valuation, it will be very, very easy to discuss the advantages and DCF as well as the disadvantages. The first advantage of this valuation is that if it is done right, it is based upon the asset's fundamental. It should be less exposed to market moods and perceptions. Since what we have done is we have captured the cash flows relating to a particular asset or a particular business model, it will be very, very difficult. It will be, very easy to eliminate the risk of market that is there. 100% elimination is not possible. Like in this COVID scenario, these risks cannot be eliminated, but the moods of the market or the market swings due to any other extra factor that can be eliminated. Since we have, we have the right approach, we have encountered the cash flow relating to a particular asset. So market related risks to an extent are eliminated. Then if good investors buy businesses rather than stock, DCF valuation is the right way to think. We have discussed that price is different and valuation is different. So price may be different at any point of time, but if you see the underlying business and you calculate the valuation by using DCF method, so it is quite possible that you will end up in a very, very good deal as compared to the price prevailing in the market. Or you can say the valuation is quite precise and which may differ largely from the price of such asset or a stock. So DCF valuation forces you to think about the underlying characteristics of the firm and understand the business. If nothing else, it brings you face to face with the assumptions you are making when you pay a given price for an asset, right? Similarly, there are certain disadvantages of this method as well. We have seen yesterday in the example as well, there are a lot of inputs that are required. So inputs are very noisy as well. It is very difficult to estimate, especially the future cash flows, if there is no fixed contract or there is no committed contracts with the party. So it is very difficult to estimate the future or estimate the future earnings over the explicit period, as well as make assumptions relating to growth, the terminal value, the other factors such as capex requirements or the working capital requirements. So these are very difficult, and the most disadvantage of this DCF valuation is that since there are a lot of inputs, even a small tinkering in any of the input will make the valuation go wayward. So it can be manipulated by some savvy analysts to provide the conclusion that is the demand of the appointee person, and it can lead to manipulation as well. We have seen there are formulas in Excel that can lead to the desired output without putting in the input. So this is one of the disadvantage of the DCF model. In an intrinsic valuation model, there is no guarantee that anything will emerge as under or overvalued. Thus, it is possible that in DCF valuation model to find every stock in the market to be overvalued. It can be possible that every stock in the market is overvalued, especially when the market is going upward without any fundamental change in the business. So in those scenarios, it will be very difficult for equity research analysts to justify the pricing that most of the stocks in the market are under or overvalued, right? This method works best, and it is the easiest form to use for assets where the cash flows are currently positive and can be estimated with some reliability for future periods. There may be some reliability on the future forecast or future earnings. Then this method is the easiest to use, and where a proxy for risk that can be used to obtain discount rate is available. If there is a proxy available, then it is very easy to use this method, and it is the best form of method suited for such scenarios. It works best for investors who either have a long time horizon, allowing the market time to correct its valuation mistakes. Since we are taking the explicit period and we are considering the terminal value, taking into account the growth rate based upon inflation. So it is presumed that in the long run, the market will correct itself if there is a temporary up or down in the market. So it is presumed that in the long run, it will be encountered in the growth rate, and valuation will be arrived based upon the same. It works best for investors who are capable of providing the catalyst needed to move price to value, as would be the case if you were an active. So basically, what will happen is like the difference between price and the value will diminish over a period of time in the long run, since the market corrects in the long run, and we have considered the long-term growth rate of the business model that is largely dependent upon the inflation of the country that is in operating. So before going into this specific aspect, there are some adjustments that are required to be done in the enterprise value per share or by using the DCF model. What we have discussed yesterday is we need to what we need to do is to calculate enterprise value by taking NPV of explicit period of 4 to 6 years that we have done. Then we have added the present value of perpetuity, that is the terminal value. We have seen it yesterday how to calculate the terminal value. Then there are certain adjustments that are required in the enterprise value as well. Like for example, we have discussed there are certain non-core assets with the entity that is not contributing to the business model. For example, the company may be having land bank which is not at all used for the purpose of operation. So these are all surplus assets, and the fair value of these surplus assets need to be added to the DCF model. Since these have not been encountered in the DCF model by any mode, so we have to adjust the fair value of surplus assets and add it in the enterprise value. Similarly, is the fair value of investments and deposits. Since these are not considered in the future cash flows, these need to be added. Uh, in case you are valuing an NBFC using the DCF model, this line item will not appear, because in NBFC the sole business is interest income and dividend income. So investments and deposit will be their mainstream business, and this revenue will be covered in the operating part. So this adjustment will not be there in case you are valuing any NBFC or valuing any entity, any investment entity, right? Then the next adjustment is required for the present value of MAT credit. MAT credit that is available in the books of accounts will not form part of working capital requirement, and this will be benefit for the same will be available over a period of time. Now it is, as per the Income Tax Act, you can take the MAT credit over a period of more than 8 years. So its present value needs to be calculated on day one and added to the enterprise value. Similarly, if there are any contingent liabilities that need to be reduced on day one itself. Less share application money. Share application money is treated similar to debt. So its share application money is also reduced from the enterprise value at day one. Then the market value of long-term debt. The market value of long-term debt is reduced from the enterprise value so as to come as for to calculate the value of equity, right? We have discussed yesterday, value of enterprise value is equivalent to value of debt as well as value of equity. For arriving at value of equity, we need to reduce market value of long-term debt rather than the book value. Then the next adjustment is relating to short-term debt. In case of short-term debt, present value of an amount as at the end of the explicit period needs to be reduced. Since the movement in the short-term debt has been captured in the working capital requirements, so the present value as at the end of explicit period, say after 6 years, what will be my debt, and its present value today will be reduced for the arriving at the enterprise value. Right? Now this is the total value attributable to current equity shareholders. Then value per share total value divided by number of shares as on date. Pre-money number of shares equivalent to value per equity share. I hope all these adjustments are clear. Please, if you have any doubt, please write in the chat box. I'll also cover these in detail in few more slides. So relating to long-term debt, interest is not considered as cash cost or outflow because we are taking EBITDA only. So interest is not considered, and cost of debt is considered for the purpose of WACC computation net of tax. That is why we are reducing the long-term debt as on day one. Part payment of the long-term debt is not considered for cash flows, and long-term debt outstanding as on day one is reduced from enterprise value, right? The next is the short-term debt adjustment relating to short-term debt. Interest is considered as cash outflow or cost. Interest is not considered for the computation of weighted average cost of capital relating to short-term debt. Part payment is considered as for cash flows purposes. It is included in the working capital requirement. Similarly, movement in OD is considered as part of working capital movement. And present value of short-term debt outstanding at the end of explicit period reduced from the EV. Since all these adjustments are being done in the capital working requirement, That is why present value at the explicit period is reduced. Had all these not been done, the current market value of as on today, as on day one, should have been reduced, as we are doing in the long-term debt. So this is the basic difference and specific aspects we need to take care for our practical implementation. There may be a question relating to the same in the exam. Then relating to share application money. Share application money outstanding as on day one is considered as debt, and it is reduced from enterprise value. Above treatment is suggested since number of shares that would be allotted is not known, so it is treated at par with debt. Assumption in relation to number of shares is not suggested. However, uh, if the application money has been received based upon the certain 1-to-1 ratio or certain parameter in which the number of shares are defined, in that case we can assume the number of shares, and these adjustments will not be considered for the same now. Then allotment of shares, funds received on allotment of shares not considered as inflow for the explicit period. If there is any allotment of shares, it is not considered as inflow. No adjustment is required if funds are expended during the explicit period. अगर उस पीरियड के अंदर कुछ फंड्स जो है वो एक्सपेंड भी कर दिए हैं तो उसकी भी कोई एडजस्टमेंट की कोई रिक्वायरमेंट नहीं है. Such funds are not expended. If are not expended, such funds are to be considered as debt. उसको debt की तरह ही consider करेंगे. Present value of such allotments need to be reduced from EV as on day one. Above treatment is suggested since number of shares that would be allotted is not known. Assumption in related to number of shares is not at all suggested. This is in at par with the treatment of long-term debt raised during explicit period. The only difference is there is no interest cost, and this will not be considered for the purpose of calculating weighted average cost of capital using the CAPM model. So there are certain aspects relating to pre and post money as well as relating to preference shares. In relating to pre and post money, DCF valuation is always based on the pre-money terms. However, there is only one difference. Cash flows need to be considered based upon the post money, and amount obtained on allotment of shares needs to be considered as debt that we have discussed. Similar treatment as allotment of shares during explicit period. During the explicit period also, it is treated as debt since the number of shares to be allotted is not known, and pre-allotment number of shares is to be considered to arrive at the value per share as per this DCF method. As far as preference shares are concerned, preference shares are treated as par with long-term debt. Preference dividend along with dividend distribution tax, if any. Now, as per this amendment in the last budget, DDT has been removed. Preference dividend rate will be considered for weighted average cost of capital, net of tax. No, not net of tax, because this is not a deductible expense. So whatever is the amount as of today, it will be reduced from enterprise value along with debt for equity shareholder value. For calculating the equity shareholder value, it will be treated as par as debt. Preference dividend rate will be considered, if any, will be considered as the cost of the funds and will be considered for weighted average cost of capital. Value as on day one, or the market value as on day one, will be reduced from EV to arrive at the amount attributable to equity shareholders. I hope so far so clear. Then business asset, DCF method is primarily based on the cash flows. So income from business asset is included in the cash flows. Value of business asset implicitly captured in cash flows. Business fair value of asset used for the purposes of business not relevant, because these are being consumed in the cash flows as well. आपने जो भी assets consume करे हैं during the explicit period or till the life of the project, उनकी fair value consider करने की जरूरत नहीं है, because whatever you are earning today in this cash flows, it is due to those consumption of assets only. So the fair value need not be considered, but as well as their disposal and acquisitions are already reflected in the cash flows. by way of capex changes. So no adjustment is required for business asset, whereas business is required adjustment is required for surplus assets. Surplus asset refers to asset not actually used for the purpose of business. Income from such assets not to be considered for cash flows. So if there are any non-core investments in the balance sheet, such any income from such investment is not to be considered for cash flows. Disposal and acquisition not to be reflected in cash flows. And fair value of such assets need to be added to EV at day one. We have discussed this. Fair value may be determined through various appropriate methods. Fair valuation determination, there are many methods. Then cash and cash equivalents. Operating cash requirements need to be considered. Only operating cash requirement need to be considered. That can be determined using the cash cycle of the entity or the operating cycle of the entity. Not the operating cycle, cash cycle. Operating cycle is different. Cash cycle is different. Then current cash and bank balance is beyond requirement to be considered as surplus assets. So suppose you have a cash or bank balance of 10 CR, but you require only 3 CR for the operations of the business as per the cash cycle. And so the remaining balance is the surplus assets and need to be added to the enterprise value as on day one. Because these are surplus assets, the fair value is added to arrive at EV as on day one. These are not going to be consumed in the operation of the business for generating the future cash flows. Trade investments. Trade investments are those investments which are necessary for the purpose of business. So income from such investment is to be considered in cash flows. Disposal and acquisition to be reflected in cash flows. If generally the consolidated cash flows can be considered in case of subsidiary companies. Alternatively, what you can do is you can add the value of the subsidiary by using the DCF method to the holding company and arrive at the fair value for the equity shareholders. Whereas for non-trade investments, such income is not considered for cash flows purposes. Disposal and acquisition not reflected in cash flows. Fair value of investment as on day one. Fair value of investment as on day one is added to EV since these are non-trade investments. And fair value can be determined by using any of the appropriate method that is available or that is possible for valuing such investments. So the basic difference is relating to business and non-business assets. All those assets which are relating to business, they will be considered for, their income will be considered for cash flows. Their movement or their changes will be reflected in cash flows as well. Their disposal and acquisition will be reflected in cash flows. And in case the assets are surplus, their fair value as on day one will be added to EV and their income and disposal acquisition will not be reflected in the cash flows. Any doubt till here? Please write in the chat box. Okay, thank you. Now we are moving to asset-based valuation. So this asset-based valuation is the third and the most important approach of valuation. This is required in a net asset valuation. We need to individually value all the assets of the entity. So starting from tangible assets, we need to calculate the fair value of tangible assets, including the property, plant, and equipment, the intangible assets as well as the investment property. So all these will be valued by different valuers. For land and building, you have to appoint a different valuer. For plant and machinery, you have to appoint a different valuer. For other tangible assets, there are certain other valuers who may not be listed valuers. And then you need to calculate for the diminution in value as well, impairment losses on the same, if any. And then this is relating to tangible assets. You need to value it to realizable value or the market value. And then for intangible assets, there are three methods prescribed for valuing intangible assets. These are relief from royalty method. Relief from royalty method. The other one is multi-period excess earning method, MP method, with and without method. These all are, there are certain more methods for calculating intangible assets fair valuation and special rights that we'll discuss in that particular section only. These will study all these methods in detail there. Really, I'll just brief here only. Relief from royalty method is a method in which which is a method to calculate the fair valuation of a particular intangible assets if the entity has produced it in-house and has saved the cost by paying the royalty. So whatever royalty the company is paying, had it not paid the royalty, what would have been the benefits arising from the date from that royalty? That is the relief from royalty method. It is a very easy method, and we'll discuss that in detail. Then multi-period excess earning method is multi-period excess earning is calculating the excess earning that entity is earning from the use of any intangible asset, right? So the present value of those excess earnings over a period of time will be uh, captured, and that will reflect the fair value of that particular intangible asset. Then with or without method, in this two DCF models are used. One is without the cash flows without using that particular intangible asset, and the other cash flows DCF model using that particular intangible asset. So the difference between the present value of both the method will be the fair value of that particular intangible asset. That is with and without method. Then we need to adjust the contingent liabilities for the same, and based upon this, the net asset valuation will be done. The second method is the liquidation method. Liquidation for liquidation. So net realizable value of assets on a liquidation assumption is calculated, capturing in the liquidation cost, the taxation, the stamp duty, discount for forced sale and time factor, then the shareholder value to be impaired in case asset is charged to creditors. In case of many of the entities, those who have been part of IBC, uh, the investor value or the promoter's value has been reduced to zero because they are not being paid anything. Whatever promoters share has already been pledged to the bankers. Bankers are not going to get their entire money, so nothing is payable to promoters. So most of the promoter entities, those who have invested in the uh, those entities that has been subjected to IBC or liquidation, their value has been reduced to zero. So the third point relating to shareholder value to be impaired in case of assets charged to creditors is the perfect example of IBC cases. Then the third one is the replacement method. A replacement method is primarily the market value of similar assets useful for valuing projects under implementation. For example, if you are erecting a power plant, whatever is the work in progress or the capital work in progress as on date, if you see, if you calculate the um, market value of similar asset, that will be considered under this replacement valuation approach. So whatever is the cost that is incurred to replicate the same is the replacement cost of that particular asset. So this method is very useful for valuing project that is under implementation. For example, a particular intangible asset that is under development. So whatever cost relating to research and development that has been incurred till date, or whatever additional amount is required uh, to create a similar asset will be considered as the replacement cost, and it is uh, uh, useful for determining the value of the asset that is in there in the balance sheet, which is not complete. Summing all the valuations of the tangible assets, intangible assets, and assets that is not yet completed or under implementation or under development will get the total valuation of the entity, reducing the liabilities as well as the making adjustment for contingent liabilities. So these are all relating to valuation approaches. If anyone has any doubt in any of the approaches, you can email me or you can contact me on my cell phone. Or if you want anything to be discussed here, you can mention it in the chat box. Or if you want to raise your hand, you can raise your hand as well. I am presuming that there is nothing to be asked here. So we are moving to our next session, that is relating to international valuation standards. I hope my screen is visible.
Yes, it is visible. Valuation
Yeah.
standards.
So we are covering this very, very important topic relating to valuation standards. So we'll cover this two standards today. There are two types of standard. The first one is the general standard, and the second one is the asset standards. There are 5 standards, and that is general in nature. The first one is the scope of the work, IVS 101. IVS 102 is investigation and compliances. IVS 103 is the reporting. IVS 104 is defines the basis of valuation. IVS 105 is the valuation approaches and methods. Then there are certain assets based standards, which is relating to a particular asset or a particular sorry, excuse me, particular business model. Like for calculating for valuing business and business interest, there is IVS 200. IVS 210 is relating to intangible assets. Then for non-financial liabilities, 220, plant and equipment 300, real property interest 400, 400 run is for development property, and 500 is for relating to financial instruments. So what we'll do, like IVS 500, we will cover with Ind AS 109. We have a session on Ind AS 109. So what we will do is we will cover the standard on financial instrument along with the Ind AS 109. For development property also, we'll have a separate session on this, and we will cover it with either the fair value or the property, plant and equipment along with IVS 300. For intangible asset, IVS 210, we will cover during the valuation of intangible assets. And business interest, we will cover with Ind AS 103, that is relating to business combination. So these asset-based standards we will cover along with the corresponding Ind AS or corresponding uh, chapter on valuation. We will not cover this real property interest and development property. We'll cover all those standards other than these two along with the particular Ind AS or with the particular chapter of valuation. Today we will cover these two, scope and investigation and compliance. So before going into IVS standard, this International Valuation Standard Council has come up with this revised valuation standard as on January 2020. So it is applicable for the exam as well as for practical scenarios. There is uh, there is a limitation in the limitation, or you can say the caveat in the valuation standards that we will be using is that when you opt for IVS, you have to apply the IVS in totality. You cannot say that I'll apply a particular standard and I will not comply to a particular standard. It has to be applied in totality, and there will be no leverage, except that there are certain uh, deviations from the standards based upon the uh, court rulings or judgments, then that is only to that extent it is only permissible, and it will not be treated as departure from the IVS. If it is not due to any court ruling, then one cannot depart from IVS. Uh, in my first session in the inaugural day of this preparatory classes, I discussed the standards that I not discussed. I had just given a brief about the standards that has been issued by the ICI RVO as well. So for the members of ICI RVO, they cannot use the international valuation standard. There is a particular restriction imposed by the RVO. They can use the standards published by RVO itself, right? There are certain gaps between the two, but ICI members cannot use these standards. ICI RVO members, sorry, and other RVO members will have to comply with these standards only, right? So what does the standard say is 101, the scope of work. The standard says that a valuer must communicate the scope of work to its client prior to the completion of the assignment. Before completing the assignment, a valuer must communicate the scope of work to its client, which includes the following: identity of the valuer. Who is the valuer? Whether the valuer is doing the valuation in his individual capacity or through a registered valuer entity, which is by way of a partnership firm or an LLP or a company firm, right? So the identity of the valuer needs to be disclosed in the scope of work. Obviously, when you will get the assignment, this will be very clear because you get the assignment in the individual name. So you will definitely uh, deliver the valuation in the individual name only. So identity is very clear at the time of assignment only, but still it needs to be communicated. Then the identity of the client, who has appointed you for the purpose of appointment, for the purpose of valuation. That needs to be given in writing to the client. Then the third is the identity of other intended user. If there is any other intended user, then identity of those users will also be mentioned in the scope of work. And this scope of work is nothing but the engagement letter that we issue at the time of audit as well. So this will be covered in the engagement letter that will be conveyed to the client prior to completion of the assignment. Then what are the assets being valued? This is the most critical and the most important part of this standard. In many times it is not possible to identify which asset is to being valued. For example, if you are valuing a business house or a corporate entity, you will find there are a number of investments in those entities. And further, if you go down the hill, there are further subsidiaries or further layers of investments in those balance sheets of the investing entities. So it is very difficult to identify कि आपको किस level तक investments को identify करके value करना है to arrive at the particular evaluation. So this scope will make it very clear कि आपको किस level तक investments को value करना है, कौन से assets को value करना है. There are certain assets which are not there in the balance sheet itself. For example, if I talk about intangible assets, customers list are not valued and accounted for in the books of account. So you will not have it in the books of account. Or if you have any uh, patent, if you have applied for any patent whose revenues have not yet started, and even the patent has not been approved till date, then also there is certain value to that particular patent due to whatever research you have done. So there is some value to that, and in case the entity wants to get it valued, it has to be specifically mentioned in the scope of work. Then the valuation currency. This is very important uh, for the purpose of compliance as well. In case there are regulatory requirement to value a particular entity or for if you are valuing entity for the purpose of impairment and you have a foreign subsidiary. So it is important to calculate valuation as per the cash flows of the reporting entity or the entity that you are being valued, right? Suppose you have a subsidiary in US, so cash flows has to be in euros or pounds. It cannot be in INR. There is a possibility. We have a separate lecture on that as well. But as of now, what you have to mention in the scope of work is the valuation currency in which you are doing the valuation. Then what is the purpose of valuation? This is again a very important, and it has to be precisely mentioned in the scope of work as per the appointment order issued to you or appointment letter issued to you. What is the purpose of valuation? Because it defines the base or premise of the valuation. Why the uh, asset is being valued, it depends upon the same. You have to apply for discount for control, discount for lack of control, discount for marketability. All these factors can only be factored in if you know the exact purpose of valuation, right? We have a detailed discussion on this yesterday also. Purpose of valuation is very important, and it's need to be dotted down and conveyed or communicated to the client. Then the basis or basis of values used, whatever basis that you have used for the purpose of valuing, that need to be mentioned in the letter before concluding the assignment. And if there is any objection by the party, it's need to be written in written, and working papers need to be preserved for the same. Then valuation date. Valuation date is a very important thing. As you all know, valuation date is very critical. In case of IPC assignments, valuation date is very critical. Whatever valuation that you have done as a particular date, but then the cash flow post that valuation date belongs to the party who is the winner of the, or whose resolution plan has been accepted under the CIRP process. So valuation date is very important. And this is very important as well, because in other cases also valuation may change due to the change in the valuation date. Suppose you are valuing a particular shares for the purpose of transfer as per the FEMA guidelines or as per the Income Tax Act. So valuation date, as on the valuation date, if there is a particular set of revenues and post that there are huge amount of revenues, then the valuation will differ. So you need to uh, confirm the valuation date by communicating through the engagement letter to the management before the signing. Then the nature and extent of the valuer's work and any limitations thereon. What is the work of the valuer? How it is going to value the same, and if there is any limitation that is being imposed by the management, the same needs to be mentioned in the scope as well. Whether any limitation or restriction on the inspection, inquiry, or analysis in the valuation assignment must be identified. So if there is any limitation that is being imposed by the management, the same may be communicated to them that you have imposed this restriction on this particular thing. It may be required to limit the valuer to go beyond a particular point, but whatever is there, it has to be mentioned in the scope of work. One more thing is that if the limitation restricts the valuer to continue or give a fair valuation of the asset that is being valued, then the valuer cannot say that the valuation has been done as per the IVS standards. It is not that the valuer will leave the assignment. The valuer will insert a caveat or limitation in the valuation report itself, that valuation has not been done strictly in compliance with the IVS. The nature and the sources of information upon which the valuer relies. The nature and the sources of information could be published reports, data provided by management, or data provided by any third party as well. So the auditor, or so the valuer has to, mention the same in the scope of work as well. Significant assumptions or special assumptions. Significant assumption assumed by the valuer based on the input given by the management or by himself as well will need to be form part of this particular letter before finalizing the report. The type of report being prepared. The format of the report, that is how the valuation will be communicated, must be described. It is by written only. Restriction on use, distribution, and publication of the report. Whatever restrictions a valuer wants to impose on use of the valuation report or distribution or publication of the report, that must be communicated to the management before issuing the report. That the valuation will be prepared in compliance with IVS and that the valuer will assess the appropriateness of all significant inputs. A statement that the valuation will be prepared in compliance with all the IVS, International Valuation Standards, and the valuer will assess the appropriateness of all significant inputs. All significant inputs needs to be appropriately tested by the valuer for appropriateness, but as of as per this standard, the same needs to be mentioned in the scope of work, nothing else. Whatever inspection or other thing that the valuer needs to do, that is the part of the valuer only. This is only for the purpose of mentioning in the scope of work. A written scope of work may not be necessary. However, since valuers are responsible for communicating the scope of work to their client, a written scope of work should be prepared and delivered to the management. It is to the same authority who has appointed you. Okay? If board has appointed you, the written scope of work must be addressed to board, not to any person below to board level. So far so clear, this scope of work. Any doubt on this? There are okay, nothing in the chat box. So let me move to the second standard of the day, that is investigation and compliances. So what is in the standard investigation? Investigation made during the course of a valuation assignment must be appropriate for the purpose of valuation assignment and the basis of value. So, a valuer needs to undergo various investigations to identify what is the purpose of valuation, how the inputs have been given to him, what is the basis of value, and investigations are done uh, further to what I say is to investigation are done to understand the past performance of the entity. Past performance of the entity means if there are any wayward movement during the last 3 years due to any exceptional factor or extraordinary movement, the same to be streamlined in the cash flows. For that purpose, investigations are required. Then sufficient evidence must be assembled by means such as inspection, inquiry, computation, and analysis to ensure that the valuation is properly supported. So what we do, most of the valuers we lack in the documentation part. So there must be sufficient evidence that must be assembled by means of inspection, inquiry, computation, analysis. We generally do the inquiry with the persons or the management, but we do not document it. So this standards is all about documenting the outcome of inspection, inquiry, computation, and analysis that has been done to prove that the valuation has been properly done. Limits may be agreed on the extent of the valuer's investigation. Any such limits must be noted in the scope of work. This we have done in discussed in scope of work as well. There could be certain limitations that could be agreed to limit the extent of valuer's investigations, and those must be mentioned in the scope of work. However, if limitations on investigation are so substantial that the valuer cannot sufficiently evaluate the inputs and assumptions, the valuation engagement must not state that it has been performed in compliance with the IVS. So instead of leaving the assignment, you can say that valuation has not been done or valuation has not been strictly done by the IVS standards. There are certain, restrictions as well. For example, if I am issuing shares, if I am valuing for a company who wants to issue shares to a particular potential investor, then the company comes to me and say that you use a particular method of valuation. Instead of uh, identifying which method is more suitable or which method should be used to value the entity, the management give us a mandate to do a valuation by using a particular method only. In those scenarios, there are limitations in the scope, and these must be stated in the valuation report very, very clearly. Significant input provided to the valuer, for example, management owner, should be considered, investigated, and or corroborated. There could be there could be, you can have the evidence for the input that is being given by the management. For example, if there are certain hikes in the cash flows in the explicit period, then you can have the contractual arrangements or the copies of the contract that has been entered into by the company to corroborate whatever input that has been given by the valuer. And along with this, if you see that there are certain contingent liabilities or contingent considerations that has been not been accounted in the books of accounts, for that as well, you can have the copies of the contracts entered into by the management or the company. This all can be thoroughly done only after investigation and spending a lot of time with the for the purpose of valuation. Valuation is not a 1 day or 2 day job. It requires a lot of time. And my request is that when you value a particular entity, you understand the business first. What is the business of the entity, how it is being impacted by the internal factor, by the external factor. Only then you can investigate further and test the input for appropriateness. In cases where credibility or reliability of information supplied cannot be supported, consideration should be given as to whether or how such information is to be used. If it is not credible or not reliable, then it is very, very difficult how the same will be used in the valuation report. You need to assess what is the impact of such inputs for the purpose of valuation and how it is impacting the same. In considering the credibility and reliability of information provided, valuer should consider matters such as what is the purpose of the valuation, the significance of the information to the valuation conclusion. So how significant is the information to conclude the valuation? If the information or the if the information is not reliable and not significant even to have any impact on the valuation conclusion, then the same may be ignored on the grounds of materiality. The expertise of the source in relation to the subject matter. What is the expertise of the source in relation to the subject matter? आप जो वैल्यू कर रहे हो, if you are valuing the power plant or a power a windmill, so what is your expertise in the same, or the person that is providing you the information? आप मेरे से information ले लेंगे किसी भी चीज की in which I am not dealing, that is not good enough, right? So that is not credible. अगर आपने, for example, if I say in the case of audit, आप एक्चुरियल वैल्यूएशन कराते हैं, आप एक्चुरियल वैल्यूएशन एक रिनोड एक्चुरी से कराते हैं. So he has already established himself, he has passed the examination, he has the know how to do the actuarial valuation. So that is the reliable information. आप ESOP की वैल्यूएशन कर रहे हैं, ESOP की वैल्यूएशन में आपको बेसिकली फेयर वैल्यूएशन करनी है, या फेयर वैल्यूएशन आपको डिटरमिन करके दी हुई है, आपने किसी और उस इंफॉर्मेशन को अपनी वैल्यूएशन में यूज करना है. तो यू नीड टू सी वेदर दैट वैल्यूएशन इज गुड इनफ और नॉट, whether that holds good or not, whether the techniques used are good enough or not. अगर आप किसी और वैल्यूअर्स की इंफॉर्मेशन को भी अपनी पर्पस से यूज कर रहे हैं, then also you need to test that valuation for appropriateness. आपको सिंपली किसी एसेट को वैल्यू को अपनी वैल्यूएशन में इनकॉर्पोरेट करना है. फॉर एग्जांपल प्लांट एंड मशीनरी की वैल्यूएशन को अपनी वैल्यूएशन में इंक्लूड करना है, या लैंड सरप्लस लैंड एंड बिल्डिंग है, नॉन कोर एसेट है, उसको आपने अपनी वैल्यूएशन के अंदर इंक्लूड करना है बाय यूजिंग द एसेट मेथड। देन ऑल्सो आपको ये चेक करना पड़ेगा कि whether the valuation that has been done by the other valuer is good or not. दो आपको नॉलेज नहीं है उस चीज की, बट स्टिल यू हैव टू चेक इट बाय एम्प्लॉइंग other members of the same field, same asset class, right? IBBI requires this to be done by a registered valuer. आप किसी और वैल्यूअर की रिपोर्ट को अपनी रिपोर्ट में इंक्लूड करते हैं या पोर्शन को इंक्लूड करते हैं, you cannot abstain from your responsibility. You have to check it for the appropriateness. Whether the source is independent of either the subject asset and or the recipient of the valuation. अच्छा, अगर आपको कोई क्रेडिबल और रिलायबल इंफॉर्मेशन मिली है, आप उसकी क्रेडिबिलिटी चेक करना चाहते हैं, तो पहले सबसे पहले ये चेक करिए कि जिसने इंफॉर्मेशन सप्लाई करी है वेदर दैट पर्सन इज इंडिपेंडेंट और नॉट। इंडिपेंडेंस किससे चेक करनी है? जिस कंपनी को आप वैल्यू कर रहे हो, टारगेट एंटिटी से वो इंडिपेंडेंट होना चाहिए, और जिस पर्सन को वैल्यूएशन जो करवा रहा है, जो रिपोर्ट कर रहा है, जिसको आप रिपोर्ट कर रहे हो, उससे भी वो इंडिपेंडेंट होना चाहिए, सो दैट कि देयर इज नो चांस ऑफ एनी बायसनेस। अभी सर आज के लिए यही 2 स्टैंडर्ड्स ही प्रिपेयर थे। इफ एनीवन हैज एनी डाउट।
थैंक यू नीतीश जी, इट वाज रियली अ वंडरफुल सेशन।
बाकी के जो सर 3 स्टैंडर्ड हैं वो कल कवर करेंगे, और
हाँ
जो एसेट स्पेसिफिक स्टैंडर्ड्स है ना सर, उनको हम कवर करेंगे पर्टिकुलर, जब हम पर्टिकुलर इंडेस करेंगे, या जैसे हमने वैल्यूएशन ऑफ इंटेंजिबल्स करेंगे, तो उससे रिलेटेड स्टैंडर्ड को हम उसके साथ कवर करेंगे, तो दैट विल बी मोर इंटरेस्टिंग। और एक उसका एक एडवांटेज ये भी होगा कि अभी जो सेशन चल रहे हैं वो बहुत ज्यादा थियोरेटिकल चल रहे हैं, हालांकि ये बेसिस है, ये बहुत जरूरी है, लेकिन जब हम प्रैक्टिकल करेंगे ना इंटेंजिबल्स की, तो साथ में जब उसकी थ्योरी होगी तो इतना ज्यादा मोनोटोनस सा सेशन भी नहीं होगा।
तो मैं तो सिर्फ आपको एक ही रिक्वेस्ट करूंगा कि ये जैसे 7 मार्क्स का कवर हो जाता है, तो उसके बाद में हम 7 मार्क्स का टेस्ट ले लें।
सर एक्चुअली ना मैं 3-4 दिन बिल्कुल अवेलेबल नहीं हूँ, मैं जा रहा हूँ वैष्णो देवी।
ओके, नहीं आप वेडनेसडे तक तो है ना यहाँ पर?
वेडनेसडे को मेरा एग्जाम है, सिर्फ उसी के लिए अवेलेबल हूँ यहाँ पे।
ओके, ठीक है, कोई बात नहीं, तो वी कैन कीप इट ऑन संडे।
हाँ, मैं करूंगा जरूर, इसको प्लान जरूर कर लेंगे हम लोग। और इसका हम
और बल्कि इस तरह से करते हैं कि मानस वाला भी जो सेशन है 9 मार्क्स का, और आपका सेशन है 7 मार्क्स का, इन दोनों को हम कंबाइन कर दें, 16 मार्क्स का टेस्ट ले लें। बल्कि मैं भी अपना कुछ पोर्शन जोड़ दूंगा उसमें, मैं भी एलाइड लॉज वाला कुछ पोर्शन जोड़ के ना, तो 20 मार्क्स का कंबाइन करके ना उसका क्वेश्चन आंसर कर लेते हैं, सो दैट मेंबर्स गेट कॉन्फिडेंस कि भाई जितना पढ़ा है उतना समझ में आ गया है।
राइट,
हाँ जी। So thank you all. So we are ending the session with the permission of the speaker.
Thank you sir, thank you all the members. अगर किसी को कोई डाउट है, my email ID is there, my mobile number is also there.